FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. March 19th, 2018. Market getting romped or stomped. Market gone from a romp to a stomp. And what more is next? As always, be part of this show. Be part of the conversation. Email us at kl@kerrylutz.com. Well, onward and upward, or is it onward and downward? John Rubino knows the answer. John, happy Monday.
Hey, Kerry. Yeah, it's not a happy Monday for tech stocks and for the hedge funds that own them. A little bit of background. There was just a story about how horrible February was for the big hedge funds, which are the most aggressive, most flexible kinds of investment companies out there that are usually run by, in theory, the smartest guys in finance. But they're having a hard time. It's very hard to beat the market now. And what they did lately was they just piled into what seemed like easy money into the big tech stocks, because those are the only things that have been really going up lately. And so they're in that very crowded trade, and now tech stocks are tanking. The NASDAQ is down over 2% today, which is a pretty big move for an index. When a stock drops by 2%, not that big of a deal. But when an index drops by 2%, there's something going on out there. And what seems to be going on is that we're finally shifting our focus with these big high-powered tech stocks away from their growth prospects and towards their ability to generate free cash, which is really minimal in the case of a lot of these companies. You look at Netflix or Amazon, and they've got really impressive business models. They're growing like crazy, but it's costing them so much to generate that growth that they're not generating any cash, even as they take on more and more debt. And so you can look at that in one of two ways. Either, okay, they're going to grow forever, and eventually they'll turn that huge customer base they're creating into profitability, or they're taking on so much debt that eventually that debt, combined with their inability to generate free cash, is going to blow them up. In good times, you look at the growth story, and in scarier times, you tend to look at the debt story. And it looks like the market is shifting, at least temporarily, to the debt story. For instance, Goldman Sachs just put out a sell order on Tesla, the big electric car maker, which is highly unusual because generally investment banks want these big companies as their customers, so they never say sell their stock. So you can't really trust sell-side research, at least the recommendations of sell-side research. Facebook, meanwhile, is in a controversy over how its news features are being misused by trolls and the Russian government and pretty much everybody else. And Edward Snowden just came out and called Facebook a surveillance system masquerading as social media. And so Facebook is down big today, so that's the kind of thing that you tend to start seeing highlighted out there when the psychology of the market changes. We focus on the bad news instead of the good news, and that appears to be starting to happen now. So we'll see where it goes, but it's definitely a psychological change in the market that, should it continue, could really snowball, because these stocks are wildly overvalued based on fundamental indicators like cash flow. And if we are entering a phase of the market where that kind of thing matters all of a sudden, then there are air pockets under these stocks. You can see 50% declines in a stock like Netflix without any change in their reporting or their, customer acquisition or anything. They could be the same company, but they could be worth 50% less just because the market has decided for now to focus on cash flow. So, a very interesting time, and maybe finally the short sellers are going to get a little bit of theirs back. It's been a brutal 5 or 6 years for anybody who's trying to focus on fundamentals with these companies, because that hasn't mattered.
Yeah, I didn't think fundamentals mattered anymore at all for anybody. Where was I wrong?
Well, you were completely right for the past 6 or 7 years, but eventually fundamentals do matter. That's the long-term arbiter of financial asset prices is the underlying fundamentals. But there are times when we don't care about stuff like that. Mm-hmm. And in the ramp up of a bull market, that's the time, and especially at the blow off top, where everybody just sees something rising and they buy it because it's going up, and then they rationalize it afterwards by cherry picking the good news, the positive part of the story, and ignoring the negative part of the story. Then once a market peaks, that psychology flips over, and we ignore whatever's good about a company and focus on what's scary about it. In the case of Tesla, for instance, which, full disclosure, I'm short Tesla, so I'm kind of talking my book here. But
it's all right. You've been short a while.
Yeah, but they're selling more cars week after week, month after month, but they're not selling enough cars. They're not producing enough to generate positive cash flow and to pay off their debts. They're having to take on more and more debt, which is in the form of junk bonds, in order to ramp up their production. Now, at the same time, every other major car maker in the world is jumping into the electric car market. Volkswagen is going to have something like 50 electric and hybrid models for sale by the early 2020s. So that means Tesla might be missing its window in which to take over the electric car market and be the car maker in that space. And meanwhile, they're taking on a huge amount of debt in the process. So they're liable to be a debt story rather than an innovation story a year or two from now. That's the negative way of looking at a company like that. And if people start looking at it that way, in the aggregate, on balance, more people look at it that way than as a growth story, then there are air pockets under its stock, and you can say the same thing for all the big tech companies.
Right.
Even Amazon, if you look at the money that they're making on their phenomenal growth, it's minimal compared to the debt that they have to take on to generate that growth. And so even they could be looked at as a highly risky story right now, even though they're not quite yet, but that time could come. And if it does come, they can go down dramatically, So as a part-time short seller, this is very exciting for me.
I'll bet.
Not so much fun if you're a hedge fund who just loaded up on Apple or something like that.
No. Hey, but, that's the nature of markets. When markets are booming, everybody takes on debt without thinking about the fact that, the problem with debt is, it's got to be paid back. That's really the problem, right? And
yeah, but in good times, everybody will lend you the money because they're only looking at your growth. Another aspect of this market that's really interesting is the spread between junk bonds and risk-free bonds like treasuries. Mm-hmm. And that has compressed to one of the lowest levels ever. In other words, risky borrowers hardly have to pay anything over treasuries, over risk-free returns in order to get money right now. And so the default rate on junk bond borrowers is extremely low because they can all refinance their debt anytime they want to. That's also a peak of a cycle indicator. When junk spreads just collapse down to nothing, that usually means you're 1 year away from junk bond spreads spiking to 8, 9, 10%. Yeah. Because money gets tight because the Fed is forced to raise interest rates as the economy really gets going. And the worst junk borrowers are then cut off and they fail. And that starts kind of a cascade failure of the entire junk bond sector. And then everybody panics and nobody wants to lend money to low quality borrowers. And you get this massive blowout in spreads. So maybe we're headed for that too.
Yeah. Hey, you never know. Once it starts unfolding, if this is indeed the time it's going to, then who the heck knows what can happen, right? I mean, it becomes a cascade effect. And then who's to say?
Well, you look at the chart of what happened the last 3 or 4 times, and it's a repeating pattern. Junk bonds do well, and junk spreads compress, and everybody's loading up on junk bonds because that's where you get your yield and everything, and then it all blows up. And junk bonds and equities pretty much trade the same way. So you get a a corporate bond bear market at the same time you get an equities bear market. That has happened over and over again since World War II. So there's no reason to think it won't happen at some point. So this is all, Carrie, this is all just timing now. It's not will this blow up? It's when is it going to blow up? Is now the beginning of it, or is it 3 years from now? And that we can't know until after the fact. But when it blows up, the early stage of it will feel like this. You'll see high-flying stocks with minimal cash flow, but fast top-line growth start to roll over and start to plunge. And then that'll spread to risky borrowers and that'll scare everybody. And then so on and so forth until risk off becomes the dominant mindset in the markets. In other words, we all pile into short-term treasuries and precious metals, and we don't want to see anything else. Don't tell us anything else, because everything else is bad. It's all scary, and it could go way down, and that becomes the mindset of the market. So someday, soon, that'll happen.
Here's the question. Are we heading for another 2009 style crash?
Well, again, we can't know how this plays out, but the numbers are worse now than they were in 2008, 2009. In other words, since that time, that was basically a debt-driven crisis. But since that near-death experience, where the financial markets literally almost ceased to function in 2008, 2009, and had to be bailed out with trillions and trillions of dollars, instead of getting our financial house in order and paying off debt and reining in derivatives, we basically went the other direction. We took on more and more debt at every level of every major society, and we let the big banks increase their derivatives books until their exposure to things like, credit default swaps and interest rate swaps and currency swaps is now bigger than it was in 2007. So we basically have created the conditions for an even bigger crisis. And when it comes, because the numbers are bigger, it's totally conceivable that the crisis will be more widespread and more serious.
Yeah. You can only put off your fate for so long, right? And then your fate becomes more inevitable with each passing day, doesn't it?
Well, you get what you deserve. You reap what you sow. And taking on a lot of debt leads to some kind of a crisis eventually. I mean, that's history's lesson. And we've seen it happen dozens, if not hundreds of times throughout financial history. Since there were markets, there's been the incentive to take on huge amounts of debt to get short-term gains. And that always and everywhere blows up in the face of big debtors. So there we are. We're right back to making the same mistakes that the Roman Empire made.
I knew you were going to say that. I knew you were going to say that.
Yeah,
I knew it. But
because they had one of the epic hyperinflations in financial history 2,200 years ago, and we don't seem to have learned that lesson since.
And the hyperinflations have come and gone. I don't know that we're going to have that, but in the inevitability of some big market blow off in light of the inflation that we've had in asset prices, the increase in asset prices is staggering. And I think that Bitcoin is sending a warning there. Under $8,000. I haven't checked it this morning yet, John, but it's taken a humongous hit. Humongous. I mean, it's less than half its peak. That's pretty substantial.
Yeah. We don't know where Bitcoin is going to end up, of course, but it had a huge run and then had a very predictable retracement of that run. So now we see where it goes. It's back up somewhat today.
8,600 now as we speak.
Yeah.
As the crow flies.
It was down to the low 7,000s at one point last week. So that was a pretty big smackdown. But, a lot of stuff is happening in the Bitcoin market that has less to do with Bitcoin itself than the reaction of governments to Bitcoin. Everybody's talking about regulating it in one way or another. And some of the big social media networks are refusing to take crypto advertising
Yeah, I saw that.
That's the latest story is that I think it was Facebook, right? And then Twitter stopped accepting ads for cryptocurrency ICOs and things like that. And that scared the market because how are you going to sell these new coins if you can't advertise them
they can
in a place where potential buyers are watching?
Well, they can always advertise on dollarcollapse.com and Financial Survival Network. We'll take their ad money, although we want to get paid in fiat dollars rather than coins. But otherwise, hey, we're cool with it.
Yeah, we are. So come on over, Bitcoin. We'll make you a good deal on some ads and things. But hey, Gary, do we have time to talk about junior miners?
Yeah, let's talk about it in acquisition. Yeah, let's spend a couple minutes on it. Sure.
Okay, because this morning, Hecla, a big silver miner, just bought out Klondex, which is a junior, kind of beaten down junior gold miner, for a 50-some% premium over the previous close. Not really nice, quick capital gains, gain for the people who owned Klondex stock. And the reason that stuff like that is starting to happen is that the big miners can't find enough resources on their existing properties to live. They're taking more gold and silver out of the ground right now than they're finding, which means they're basically evaporating as a functioning mining entity. So they got to find resources somewhere else if they can't find it through exploration on their properties. So they're looking around for junior miners that have found substantial properties, big enough to make a difference for a major mining company if they buy them out. And there aren't that many of them. So there could easily, going forward, become this feeding frenzy in which the big miners identify, a handful, let's say 15 or 20 juniors that have properties that are big enough to make a difference for them. And they go in and try to buy them. And we get, a lot of people trying to do that at the same time. And everybody front running that by looking around for who's next, who's the next Klondex. And so we could start to see the exploration and generally the junior mining sector start to outperform everything else in precious metals just because there are a limited number of them and some big players want them. So we could see a lot more Klondex type deals going forward, which means you want to start paying attention to the juniors now and try to identify the ones that are most logical takeout candidates in the year or two ahead, because, an overnight 50% gain, that's not what you would get if you stayed with a junior miner that didn't get taken out and the junior grew and became a mid-tier and then maybe even a major. That's a 10-bagger process there. But it looks like the reality of the junior sector is that most of them are going to be taken out for nice gains, very quick gains, but unfortunately not the huge gains that you get if you stick with one for 5 or 10 years and it keeps on growing that whole time. Yeah,
I totally agree with you. There's tremendous opportunity for quick advance if you can identify those. And that's why Rick Rule is always talking about prospect generators, that's his thing.
Yeah. And, he's one of the guys who's made a career out of finding things like Klondex and getting in at the right time.
Yeah.
So, one way to do this, because obviously a regular person can't differentiate between a good junior and a less good junior, because that takes a visit to the mine and a meeting with the people running it and everything. And that's beyond the scope of most people's expertise and abilities. So you need to find people like Rick Rule and Jay Taylor and a handful of others who are experts at this and who do it for a living and see what they're turning up. So just what I do is I listen to the interviews of somebody like Rick Rule. And when the interviewer finally says, so who are your favorite mines? Which are your favorites? And he names 3 mines. I wrote those names down, put them on my watch list, and then eventually buy them. I've got a long list of Rick Rule's past favorites. And, so far, so good. Most of them are at least still in existence, and some of them are doing really well.
Hey, absolutely. And you know what? There's so many companies, but you got to be really, really careful because they all tell a wonderful story of your road to riches, that you're going to get rich from it, that it's going to be one of the biggest scores you've ever made. And how many times does that happen? Not that often. So you got to look where the smart money is here. It's not like the smart money on Wall Street. This is totally different. This is the smart money that's got their own money invested.
Yes. Yeah. There's the old saying from Mark Twain that the definition of a gold mine is a hole in the ground with a liar standing next to it. And that's more true than gold investors wish it was.
Yeah.
So you really need to be careful about the juniors because 90% of them will cease to exist. But the 10% that actually make it are potentially really, really good investments. They have these long runs in which they go up by multiples of the original price, or they get taken out for a really nice premium in a very short period of time. And then you have some extra capital to invest in the next good prospect.
Absolutely. Could not agree with you more. Anyway, check out John's work over at dollarcollapse.com. Writes more articles, meaningful articles of substance than just about anybody out there. Hey, as always, be a part of the show. Email us. The email address for your consideration is kl@kerrylutz.com. Twitter feed @KerryLutz. And the Facebook page, or the International Surveillance Network page for your viewing pleasure is Financial Survival Network. And John, we'll talk to you next Monday.
Thanks, Kerry. Talk to you then.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.